restriction on workers' comp rates prior to about 1995 was it was illegal to charge less than a certain rate. So a lot of companies, there are a lot of workers' comp writers in California that only wrote in California, and they made money. How could you not make money? The government enforced a rate that was guaranteed to make a profit for pretty much no matter how inefficiently you operate. So as workers' comp rates became really high, in 1995, the legislature, obviously in a moment of weakness, deregulated workers' comp rates, and now the insurance companies could charge as little as they wanted. And since the people in that business had been conditioned to all you have to do is sell it and you'll make money, all of a sudden there was a race to the bottom. How little can we charge and get this business? Within 5 years, the largest writer of workers' comp in California was a group of companies called Superior National, which I always thought was funny because they were neither superior nor national. But they had acquired some other companies, and they really consolidated the group around 1998, and by March of 2000, they were out of business. Their liabilities alone were like $1.8 billion, and they had almost zero assets in the company. What they had done was they'd gone out and laid off most of the risk through reinsurance, like a bookie laying off part of his risk. And the reinsurers decided, hey, we were defrauded, we're not going to pay. And it took about 5 years to get any money out of them. So the guarantee fund had to pay all these claims. The way the guarantee fund gets money is they make assessments of insurance companies. Well, those assessments were limited by law to 1% of premium. That wasn't enough. So there was a change in the law to make it 2% of premium, and that still wasn't enough money, so the guarantee fund was authorized to borrow money. So they went out and borrowed money, and the collateral for their loans were future assessments or future taxes. Every insurance policy you buy has a 2% hidden tax in addition to what they call premium taxes, which are around 5%. So, and those are all just buried in the rates. They identify those. So they had to go out and borrow about $800 million to catch up on the payments. And then our pinhead governor got in there, and we had workers' comp reform. And for a while, they thought that was going to really reduce the costs. And a lot of companies took down reserves and thought they were making money, and some new companies came into California. And now a lot of the reforms that were passed right after Schwarzenegger got into office are being thrown out by the courts. So the workers' comp industry is going to crash again probably in 3 or 4 years. So you wait about 2 years, shorting workers' comp carriers would be a good investment. There will only be a bailout in the sense they'll tax all the insurance companies to pay for that. You're not going to hear much about that unless you read insurance trade journals. It's all very efficiently hidden from the public. So and this happens in every state almost. There's certainly any of the litigious states. If somebody passes a bunch of workers' comp reform, the rates go down. For a while, everybody thinks it's wonderful, and then the lawyers figure out how to get back into the system, which isn't supposed to need lawyers. It's a no-fault system. You're just supposed to get your claims paid. But the lawyers figure out a way to get back into the system, and then the overhead of the system goes up. The legal costs, defense costs, the lawyers' fees start going up again. And they reach a point where a third of the money goes to lawyers and only 2/3 goes to people who are injured at work. Then you'll have a crash in the system. It'll be a crisis. The legislature will pass some laws. Things will look good for a while. Then it'll happen all over again. And I've been in this business for 33 years now, and I've seen about 4 or 5 cycles of boom and crash in the industry, especially workers' comp, because it's so politically charged. So,
this is a scenario where the lawyer finds a way to sue over and above the written regulation or try to get more money out of it.
No, actually, it's some claim, like somebody goes home, works in your yard for the weekend, hurts their back, comes in Monday morning and says, I got hurt at work. Okay? Your medical benefits under workers' comp are much better than your medical benefits under a health insurance policy. Plus, I hurt my back at work, I'm still getting paid. So sometimes it's hard to defend against those claims. So somebody goes out, and Larry H. Parker helps them get their money. And so that's part of it. And a lot of times, people don't get any more if they hire a lawyer, but the system is designed that the lawyer's fees don't come out of what you get if you're injured. They're tacked on in addition to it.
I want to ask you a question. I don't know if you're taking questions.
Sure, I'll take questions.
It's of interest to because I was myself. Right in the swap market. The reason that it's interesting is that Libertarian is that government insurance, private insurance, so at the end of the Clinton administration, they restored the Money Act. And companies like AIG attempted to insure mortgage loans issued by banks that they had insurance that was totally unregulated by the government. This resulted in almost a total financial collapse of financial system. And you see this as a blow to the insurance concept of private insurance, unregulated. When you see now that we need the government now to come in and regulate these markets so that we don't go through the same catastrophe that you did before.
Okay.
I challenge you to restate this question.
Okay. All right. What Stan was asking was that as libertarians, we believe we don't need government regulation of insurance. And yet the credit default swaps and the collateralized debt obligations and the mortgage bonds and things were all unregulated and almost collapsed our financial system. And do we see that as a blow, and do we need government regulation? Well, first off, it's not the unregulated market that caused the problem. To think that anything financially in this country isn't regulated is naive. The mortgage market was dominated by government agencies, Fannie Mae and Freddie Mac and Ginnie Mae, and there was an implicit guarantee that these things were good. Historically, mortgages were one of the safest investments anybody could make. That's one of the reasons life insurance companies always bought a lot of mortgages. Well, because of the government agencies and the interference of the government, directly or indirectly, causing them to write lesser and lesser quality mortgage loans, lending money to people who couldn't afford to pay it back. Or as one of my favorite newsletters said, people buying more and more things they don't need with money they don't have that they'll never be able to pay back. And, all the refinancing as values went up. A lot of this was government driven. the financial system wouldn't collapse if the government stayed